Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up, PayPal, we're going to the moon. No, we're not. Let's get to work. So this channel is dedicated to the rational cash flow investor, and we try to approach stocks by looking at how much free cash flow they make. If we buy it today and hold it for a decade, what does that free cash flow compound into? How can we effectively beat the market? Please remember to read the 10K for every investment. PayPal is no exception. We're going to go through Q1 2022's earnings release for PayPal and figure out what's going on with the stock. The stock is down significantly since we reviewed it last year or earlier this year. And I want to take a look. They've updated their guidance for growth. It is lower than we thought, so we're going to have to revise our expectations downward. Let's see what that does to the stock price, and if today at low valuation, if it's a good buy or not. Now, we're going to evaluate all stocks on this channel with 5 key factors, and those are, number 1, top line revenue growth, got to be there. Number 2, EBITDA growth. We want to see strong EBITDA, enterprise level earnings growth. Number 3, strong free cash flow. Number 4, low debt. And number 5, a well-priced stock. What is a well-priced stock? It's a well-priced stock if I can put a conservative forecast together and that return is expected to beat the market. That's the idea. And that is the basis for due diligence. If you can kind of check these boxes, it kind of goes into a pile for further due diligence. Always do your research on stocks. All right, let's take a look at the Q1 update and kind of walk through this that they released. Very interesting report. A couple things I want to point out right here. So active users, 429 million active users. That's up 9% year over year, or 35 million active accounts. So active users are still growing. The next thing I look at is total payment volume. This is the amount of all the money that's swirling through their system or passing over their system, of which they take a small fee on every dollar that rolls through there. And that's $323 billion in the quarter. It's up 26%, 3-year consolidated growth. That's fine. But really, we want to figure out, is that up? If I annualize this number, it's about $1.2 trillion, which is up about 10% year over year from the 2021 full year numbers. Let's take a look. Free cash flow, $1.1 billion. They do make free cash flow. So what we want to try to do is figure out what this business truly makes and where it's going to grow. And let's take a look at this in some historical context. You ready? Let's go. All right, before we look at the financials, and we're going to look at 9 years of historical financials, I want to look at their drivers of the business, active users and the total payment volume, to figure out where that business is going. So in 2015, they had 179 million active accounts. And that's grown to 197, 227, 262, a little down, 305. And then last year, 426 was the year-end number. And the growth rate annually was pretty strong, with the biggest being kind of a COVID bump and a lot of the cryptocurrency trading they were doing. That really moved the needle on the active users. It seems like it's reverted back down to a more normal rate going forward. And then, so these users then are transacting in money, dollars, euros, whatever the dollar amount is, or currency. These are in billions, so that's $281 billion USD. That's grown to 354, 451, 548, and so forth, to 1.25 billion last fiscal year, 2013. Up 34%. The interesting thing here is this growth rate is faster than this growth rate, which means that the customers are growing, and then the customers are increasingly transacting more and more, which means they like the service. And that's one of the things we really like about this company. It's one of the reasons we had a buy recommendation, or not, we don't make recommendations here, but I bought the stock. I was interested in the stock because I was watching this growth in customer user count, this growth in transaction volume, thinking that's really, really a good sign of customer satisfaction. Well, what have they done? So going forward, their new guidance is really this number here, that 323 billion I referenced on the last quarter. If I annualize that, right, times 4, that's roughly $1.4 billion of total transaction volume, which is what they make their fees off, right? They charge a couple basis points on each transaction. Well, that's a 10% growth year over year. That number was 20% in our last model. And it was 20% because we were looking at this pattern saying, okay, Maybe they're not going to go 30% again. Maybe they'll go 20% the following year. And then, as we always do, we bring it down over time. Well, there's a sharp drop that happened, and that's what reset the market. That's what reset PayPal's price. Is they said, oops, we're not growing at 34% annually. We had 20% in our model. We're growing at 10%. So even though I was conservative at 20%, they're saying, no, 10%. And what am I going to do? Revert back higher after that? No, I'm going to keep it to be conservative. I'm going to say it's going to continue to decline, but it's going to grow at a slower pace because the world's just a little different than it used to be pre-COVID. And so what does that do? That takes transaction volume to 2.7 trillion out 10 years from now, growing at a 10, 9, 7, so forth rate. Okay, let's go back and look at their financials. Then we're going to forecast forward, and we'll come back to this sheet. But I wanted to give you a preface of what to expect. I think the revision of their number is serious, and we need to figure out what does this really mean to value long-term of the company, and then what's some lessons learned. All right, let's take a look at the revenue and EBITDA for PayPal. These are in millions USD. Revenue has continued to consistently grow over the year, which is fantastic. 2013, $6.7 billion. Then 8, 9, 10, 13, 15, 17, 21, 25. I mean, that is fantastic. And the funny thing is, they're still forecasting growth. I don't think there's never a question of, is this company going to grow? The question is how fast they're going to grow and what market multiple do you assign to that growth. And that's going to be the story here, and let's keep going. So that's an 18% annual CAGR. EBITDA is growing $1.4 billion to $5.2 billion. That's consistent growth every year. Great to see 18% annualized growth. That too is expected to continue to grow long term. I think there's a revision here as they reset margins. This margin here is coming down. Once they reset that margin, if top line continues to grow, earnings should continue to grow long term. Long-term debt, total debt has been very, very reasonable. $1 billion to almost $10 billion currently. They have lots of excess cash, although I will note the substantial drop in excess cash last year, which is concerning. Market cap is average share price times shares outstanding. I use the fully diluted shares outstanding, so I get $223 billion market cap, up from $48 billion market cap only a few years ago. That's what, a six-fold increase in so many years. That's a really, really big growth. Debt to EBITDA, right, our risk of bankruptcy measure, I'll put that in air quotes because there's lots of measures that you can use. This is just a benchmarking that we use. Typically, banks will underwrite with covenants on a debt to EBITDA basis. So I like to use this. Zeros at one time. We want less than 3 or less. This is 1, that's good. Enterprise value EBITDA. This is our market multiple, or one of the market multiples. We use a free cash flow yield, and we use a market multiple approach. And what you can see here is it was at a 20 times early on, which is rich, but fairly reasonable, rich. And then that has grown or ballooned up to 65 times in 2020. Which is a very rich market multiple to pay for a business. And what happened is that post-COVID, that multiple is coming down. The Federal Reserve is raising interest rates. That is causing a lot of reshuffling of the equity and the chase for yield that people were diving into the stock market and the real estate market. As interest rates rise, bond yields, well, bond prices fall, but that means yields rise. That becomes more attractive for investors that want yield. Pension funds, endowments, and so forth that want yield will buy bonds as a guaranteed payment rather than the dividend yield in the stock market or buying real estate. And what that's going to do is it's going to suck money out of the real estate market, out of the equity market, and into the bond market once interest rates and bonds get high enough to be attractive. And when that happens, that means market multiples are coming down across the world. And you're seeing the 65 to 44, that multiple is going to continue to come down. I think this is the true risk of the PayPal stock investment. The company seems to be growing earnings, which is nice, but the market multiple is coming down because out here it's pretty much at the stratosphere of 65 times. This is times earnings. So annually, they need to make at least $4.2 billion annually to pay itself back at a $280 billion valuation. The only reason someone would pay that high of a market multiple is you expect growth to be rapid. Well, if growth isn't, which is what they just revised growth slower, that means this multiple isn't warranted. That means price takes a massive haircut, and that's what we've just seen. So it's sitting at 44 times this last fiscal year. Stock is down again. We'll figure out what this means and if it's a buy now, finally. So 44 times. Overall, revenue's growing, EBITDA's growing, low debt. That's checking some boxes. Let's go to free cash flow. Okay, free cash flow here, and there's some important adjustment that I have done. I've taken the cash flow from operations and I've removed the stock-based comp. So I'm expensing stock-based comp as though they paid it in cash, just to hit the cash flow and be a little extra conservative. That's $1.7 billion to $5 billion, 14% annualized growth rate. And with the exception of, say, this spike here, it's been fairly consistent in growing, which is nice and in line with the EBITDA. CAPEX is limited. It's a software business. Most of their development costs are sitting in the engineer salaries that they pay and in the stock-based comp that I expensed. So basically $1 billion. I'll keep that billion going forward in my forecast. Debt is minimal, with the exception of here taking on some debt in the pandemic line to draw on some lines of credit for some extra cash. That is the really only draw into cash they have. For the most part, it's been zero. Free cash flow for the business, that is what the true business is there to produce, what you and I are buying. Shares outstanding, basically flat, so they're not really, they're not buying back shares with their cash. It's sitting on the balance sheet, which is, I referenced earlier, the cash in the balance sheet. Free cash flow per share is basically just taking free cash flow divided by shares. $3. So this debt is essentially zero. So I think they're producing around $3.30 per share in real free cash flow, holding debt constant. That's a fair number. The interesting thing though is the price is $80. So that yield is $1.8. I think the shares are currently $78. So the new yield right now, 4%. So it's yielding 4%. That's a significant drop from the 180 or the 223. Let's figure out what that means in terms of a forecast. Okay, to forecast this stock, what we're going to do is we're going to pick back up on our payment volume, right? Because these guys take a fee on every dollar that moves through their system. So much like a per store model, if this was Starbucks, we'd look at every single unit, how the units grows revenue. Here, we're gonna look at payment volume. So I'm taking payment volume down. I think this is, in my opinion, a very conservative forecast. They should be able to do this. They're all over the e-commerce world, and I would expect them to beat this number. But I don't have much evidence of that. It's coming down. So I'm gonna run with a low conservative number, and let's see what this pans out. 1.4 billion. That's annualizing the Q1 number that they put out. And I'm going to grow it going forward. And what I'm going to do is I'm going to take 2% of that and make that revenue. And I did that because historically, revenue by volume is roughly above 2%. I brought it down. They complain about higher transaction costs, so I'm going to bring that down. And I get my revenue, $27.9 billion of top-line revenue for PayPal based on 2% fee on the 1.4 trillion that they've run through their system. That gives me a revenue forecast. EBITDA percentage historically has been high 20s. It was 20 in the model based on 8 years of almost above 20. I've cut that back to 15%. Let's figure out why. In their Q1 deck, they're talking about operating margins and operating margins declining. This drop from basically 17 to 11% is concerning. We are looking at this range here. We're saying, okay, it's going to continue, but they're citing higher operating costs as a reason that they're lowering guidance, and that's hitting margin. So we're going to hit margin going forward and assume margin is going to be permanently weakened at 15%, which is a hit to EBITDA. And so what I do is I have my revenue forecast. I've got EBITDA of 4.1 billion. That's down year over year, but then it continues to grow after you reset margins. Hopefully, you don't have to reset again. So that's EBITDA. If I look at cash flow, adjusted free cash flow, I can take a ratio between EBITDA and adjusted free cash flow. Get these numbers. My CAPEX, basically 20% of adjusted free cash flow, which is what they've been running at historically. No debt. I got a free cash flow forecast. I'll put into a per share for you here shortly. All right, let's talk forecast now. EBITDA. I just showed you how I came up with the EBITDA forecast. Again, even though this is resetting down, I'm still expecting growth over the long term. The growth is just muted. It's just less than it used to be because A, we cut down the total payment volume. B, we cut back the growth rate of that total payment volume. So what that does is that gives me a long-term forecast of $8.3 billion of EBITDA. I gave a lower 17 times market multiple, a massive haircut from last year's 44, and I think I had 20 as a market multiple in the previous version. I'm dropping that because the entire world is just coming back down. That gives me a long-term enterprise value of $141 billion, less some debt plus some cash, market cap of $136 billion. Less some shares gives me a $115 price target out 30 years for PayPal. Let's take a look at forecasting free cash flow per share. Now you saw this earlier, $2.36. That's dropping 30% year over year just based on my flow. That puts it at $3.45 out 10 years from now. I put a 4% yield. I think that yield was about 2.5%. Or 3% in the prior version. It gives me an $86 price target, much, much lower than we used to have. All right, here we go. Now we've got two different forecasts for PayPal. I've got a free cash flow model, $86, and a market multiple, $115 for an average of $100 a share. Right now in the market, I can buy as much stock as I want at $73 per share. Let's put this into an IRR and figure out what it means. All right, our IRR calculation gives us the percent of cash flow that we own right here. We're buying it at $73, we sell at $100, the IRR distribution, and it produces an 8% return, which is sub-market and really surprising given the recent decline in the stock. You would think that stock is down, therefore it's a good buy. But no, it looks like the higher value it used to have was completely unjustified. And the model that we had previously is it doesn't seem to work right now. We have reduced the average payment volume. That's down from 20% to 10% year-over-year growth. We've cut margin back from 20% to 15%, and we reduced the enterprise value market multiple and increased the yield required at the exit. All three of which have compounded to lower the forward price target significantly, making the current price justifiable for its long-term possible return. And this is a case where market multiple contraction is really hammering the stock price. We like stocks that it works in reverse, where you buy a low multiple and it goes to a high. We have a lot of examples now in this world where we're going from high multiples to low, and that's going to stay that way for quite some time. So let's review the 5 key attributes. Number one, top line revenue growth. Yes, it's still growing. EBITDA is growing long term, yes. Strong free cash flow is good. Low debt, yes. Well priced, no, it's not. Unfortunately, if we have a real conservative forecast, it's not. Now, you can ramp the forecast back up and say, you know what, I'm going to continue to grow it at 20%. I'll continue to give its high market multiple. But I think that those days are over, and we need to readjust growth curves, go after cash flow, and the cash flow here is not enough to support the long-term value of the stock. So I'm going to give it a giant meh. I like the company. I like the stock. I own the stock, so I'm in a negative position in the stock. I'll continue to hold it because it will continue to grow, and maybe they can pick their growth back up and it rebounds. But without evidence for it yet, without further guidance from the company, I'm going to sit on my holdings and just ride it out, and hopefully it returns. But I think this is a lesson here of market multiples getting too aggressive and believing in the show, if you will, believing that the market will continue to grow forever and ever, and sometimes we are surprised. So I hope you like the review of PayPal stock. If you like this, check out my website at the link below, cashflowinvestingpro.com, where I teach you how to be an analyst, how to use a financial model. I give you the template. We walk through Apple and how to read their 10Ks, how to build a forecast model for Apple, and let you start understanding how to build a portfolio. If that's too much work, and if you don't want to, you can join the Cash Flow Club. I produce one-pagers on a whole host of stocks every month that we release into the community. Lots of cash flowing stocks that actually produce pretty substantial returns on a pure cash basis without relying on large market multiples. There are stocks that are yielding 20% expected return with a 6, 8, or 10 market multiple that's required, not a 17 or 20 like a PayPal. So there's a lot of value there. Definitely check it out. You can also check the link below for a free one-pager. If you go to my website, on the link down below, cashflowinvestingpro.com, you click the link in the upper left-hand corner for the Cash Flow Club. You do preview, and you can download the very first reports. Take a look at it. I've got 10 years of historical financial, both cash flow, earnings, EBITDA. I give you forecasts for both cash flow and EBITDA basis. I give you IRR, and the 5 key factors are summarized off to the right, plus a description of the company and kind of background on what they're doing. Definitely check it out. Lots of people are joining the club. Thank you very much for the time. I really appreciate it. Click the subscribe button. Let me know a comment down below what you'd like to see next. A lot of great value stock suggestions down below. Thank you very much for the time. Up is going to pop a couple other clips of some value stocks that you might find interesting. Definitely give them a look. My name is Cameron Stewart from Rational Investing. Thank you very much for the time. Bye-bye.